I believe that all you need as a fund manager is 100 trustworthy investors. That's all you need is you need 100. If you can exceed that, great, but you don't need more than 100. Um, Meetup is one. The other is your own, whatever network you're comfortable with. Some people are not comfortable with Meetup. So it could be from your church, it could be from your synagogue, it could be from your golf, or it could be from your college fraternity, doesn't matter. From the military, doesn't matter. But you got to have 100 people that are accredited that will trust you with their money.
Hi, Adam Gower here, founder of GowerCrowd.com and host of The Allocator, a new way to finance real estate podcast and YouTube series. Thank you so much for joining me today. My guest today is Bobby Sharma, who I met through Connected Capital Fund. Now, Bobby runs his own fund. He runs an educational platform, Connected Capital, that caters to capital allocators. And he is a wealth of knowledge about the industry. He has some deep insights, some deep experience. He's raised some money for sponsors as an allocator. He's raised money for himself as an allocator for his own deals. He's very, very interesting, and he knows a lot about the industry. So you are in for a fire hose of insights into how the capital allocator business works. If you've not already done so, please go to GowerCrowd.com and sign up to the newsletter. I send it out every week. It is designed to be educational about the world of real estate investing, and as best as I can, is oriented to anybody with an interest in real estate investing, whether you are a sponsor or a passive investor. All right, here we go. Without further ado, Bobby Sharma, my guest this week. Bobby, how nice to see you. It is a hat trick today.
It is a hat trick. Great to see you.
With you.
Third
It's
time.
always a pleasure. So anyway, let's start at the very top. Let's start actually with what you do, and let's think about connected capital first.
Yeah.
But what is it that you do, and then we'll dive in a little bit deeper. So high level.
So I do wear a lot of hats, but my three primary hats. One is I run a fund. I'm a fund manager, and that fund's doing well and it's growing. So that's my primary responsibility. I've got about 90 investors in that fund, so I do have to take care of them. That's my primary. The secondary is this community that we're building called Connected Capital. And fortunately, 24 was a great start. We got started and we got a lot of traction, a lot of positive feedback, and people are encouraged, and they want to belong to a community where they can be around like-minded people and invest properly and do the due diligence that you and we often talk about with Madhvi. And then the third is, just my own personal portfolio that I got to keep an eye on. I'm a GP, and I have my own personal investments that I've done. So even though I've been neglecting them, but I do have to keep an eye on them. And then of course, the rest is just traveling and socializing and but enjoying life as well.
All right, good. Well, yes, I did mean in business. I'm sure you do plenty of else outside of business.
Yeah.
All right, so let me just drill out. I'm interested in understanding some numbers as well. So the fund with 90 people. This is an allocator fund, right? So you've found sponsor. Just talk about that a little, and if you don't mind, and if you don't mind sharing,
Yeah.
talk about numbers, like how much you've actually placed, and just to kind of give a bit more detail on that.
So in that fund, 80% is I'm a private money lender. Just as some little trivia, I was the first fund on the Avister platform.
Ah,
This is going back almost 4 years ago. So I was the first paying client of theirs, and and luckily the fund has grown. So I do fractionalize my loans that I lend to rehabbers, and I know you're a GC, and you were doing flips, or you are maybe, but most of the time it's rehabbers in Northern California that need capital, so we allocate capital to them.
And so, just for clarification, I'm not a flipper, by the
Yeah,
way, just so you know, I don't do
you
flip.
build, you build.
But I am a general contractor, even though I haven't used my license for a number of years.
Yeah.
And the scale of projects I've done have ranged from hillside duplexes to ginormous commercial properties. So I've done just about everything. So how much have you raised then from those 90 investors for your? It's a
We're
debt fund, right? You call
most,
it
well,
a debt
no,
fund.
because it's on the Avistra platform, I can also invest in other people's deals. So for example, we have invested with other syndicators, other sponsors in Dallas, Lincoln, Nebraska, Richardson, San Francisco. Yep. What we've done is basically found some great operators that we had some experience with before. The fund is basically me and my partner. We don't have any employees. We don't have any. It's just me and him.
So how,
And
how does that work, Bobby? So let me I just kind of want to unwrap this and understand it a bit better.
yeah,
So you were the first person on the Avista platform. That's
yeah.
really,
Mhm.
I hope they give you a plaque or
They haven't
something.
so far, but
They give you a plaque in their offices, maybe in a picture of you, bronzed on the wall or something. But
Mhm.
right, so you formed a fund on the platform. And being on the Avista platform, what that allows you to do is, and I'm making this up, so you just correct me. I just want to, it's like in the form of a question. This allows you then to, based on, they give you all the documents, all the fund documents and the offering documents and everything.
Yep,
Then your job is to bring accredited investors or investors into that fund.
accredited. Yep.
And then you are permitted via the terms of the fund to make investments in other sponsors, but those sponsors show up on the fund on the Avista platform as well.
on my
Can you
on
just
my on my version of the Avistra platform, on my my fund. When they log in, of course,
ah
the technology I'm using is Avistra, but it's my fund with the branding and everything of the
I see.
yeah, yeah,
Okay, so somebody goes into onto your platform, and what they see is the fund. What's it called? I don't know.
a better capital fund,
Better Capital
better
Fund.
better
Better
capital
Capital Fund. All right. So they see Better Capital Fund and they think, oh, so I got some money I want to invest. I like Bobby. He's a nice fellow.
fund.
And so they go onto your platform. And what they see then is a selection of offerings
Yep,
that they can invest, they can allocate
yep.
their money to.
Yeah.
So it's inside, it's the same fund docs.
Same. They become a member. They become what's called a limited partner inside the fund. But the way the PPM is written, they can allocate their capital to any amount of money at any time. It's not time dependent, as long as there's what are called units available. They can and when they log in, they see how much is available, and they can say, okay, you know what? I'm going to put 50,000 here, 30,000 here, and 20,000 here. So they can basically build a portfolio for themselves made up of debt and then equity, right? So they have a little like a balance of both debt and equity. The debt pays right away. My tagline is wired today, earn tomorrow, right? So we pay around 10 to 11% on the debt. Then on the equity, usually, these are some value add properties. So they take a little bit longer to provide a distribution. So sometimes they have to wait about a year and a half to see a distribution. And then they have the idea is that the returns on equity are going to be significantly higher than 10 or 11%. So they'll do well, but they got to be patient.
And so
Uh,
the way that that works then is that what you do on the Avista platform is Avista provides you with a huge marketplace of sponsors. And you go, and again, I'm saying this in the form of a question. You go in there and you think, I'm going to see which of these sponsors I know and like. And then somehow you click a button and you toggle that sponsor onto your platform. Is that right? Onto your basically onto a better capital platform.
Slightly differently. So, yes, there are a bunch of sponsors on their platform, but unless they have gone through my due diligence or through connected capital due diligence, they don't get into my fund. So either, yes, but I'm sure there's a bunch of great operators and syndicators on their marketplace, but I take a slightly different approach in that I go with the sponsors that I've known and I've invested with before, and me and my partner both agree that we're going to go with these sponsors, or they've gone through the gauntlet of connected capital and gone through the whole vetting process, due diligence, underwriting. Then I can bring them into my fund. Otherwise, no.
And do they have to be on, this is kind of a just practical question, but do they have to be on the Avesta platform? They don't. Okay. All right. So now when you go on like looking at Avesta or if it's somebody else, you decide to invest, you either negotiate with a sponsor preferential terms or on the Avesta platform, those preferential terms have been pre-negotiated. Is that correct? Can you discuss that a little bit? How does that kind of,
On
in other
the
words, how do you make money?
Yeah. So on the Avister platform, what's available in their marketplace is basically whatever's published rate is what you get, whatever their published rate is. Versus when I go to and I identify my own syndicators, operators, either myself directly or they've gone through the connected capital route, then we have pre-negotiated some better terms for ourselves as fund managers. The limited partners still get the same returns if they went to them directly. So the idea is that the limited partners are not going to be shortchanged whether they come directly to the sponsor or through the fund manager. And then on each of the beauty, the Aviator platform, talks, they're sort of the secret, sauce is the customizable fund, right? So, and basically all you have to do is a deal disclosure, but your PPM stays the same. But to your point, Adam, we the ones that go into my fund are only the operators that have gone through my vetting process or the connected
I
capital.
totally understand that. So give me some actual numbers. So for example, just pick an example where you've invested with a sponsor, either through Connected or that you've, etc. So you do due diligence, so you get to know them, you get to like them, and they have terms that they offer their investors, but you
Yeah,
negotiate special terms. Now, you and I know this story,
yeah,
but listeners may not.
yeah,
So, can you explain exactly how that works and give me actual numbers from a case study, like a real
yeah.
example?
So I'll give you a live example. There's a self-storage operator. Uh, they were going to give their LPs a 60/40, sorry, 70/30 split. So 70 to the LPs and then 30 for themselves. And a 6% preferred to their LPs. So just for the listeners that don't know what a split is, it's the cash flow after all expenses It's basically all free cash flow, free flowing cash flow, appreciation, depreciation, all combined into one. They split that between their investors and themselves. Normally, the terms are 70/30. Sometimes they're 50/50. Sometimes there's a waterfall, but we won't go into that right
Mhm.
now. But this particular uh, operator was so impressed with our community and what we were doing and the ease of working with our community. They actually gave us a 90/10 split. Now, that's a little bit of an extreme. That's 20% delta between what the standard LP would get and then versus if they came in through us. And then it's up to the fund manager to take that 90/10 split and offer 80/20 or 70/30 or 75/25 to their LPs. But that's a real live example. This got funded in Q3 of late Q3 of 2024. And basically we raised seven figures for them.
Right. So that was the
Yeah,
point that I was going to
yeah,
make
yeah.
is that the sponsor didn't do that for a $50,000 investment, did they? So
No.
you had to presumably there was some, you said seven figures, so $1 million. You basically said if we can bring you $1 million or more, I'm guessing. I don't know. I mean, you be honest with me. I mean, I'm
Yeah.
interested in the actual
So,
numbers. Well,
so
I don't mean
yeah,
honest. I know you're being honest. What I mean is be precise. Good to have
yeah,
numbers.
it was 1.5 is what we
Okay.
made for them in a
And
fairly
in
short
or
amount of
and
time.
what they said to you, in order for a one, if you bring us 1.5 million, we'll give you 90/10.
Yeah,
And was there a preferential pref? Did they give you more
yeah,
pref?
yeah. Eight from
Okay,
60
so
to
eight.
50.
Okay.
Yeah,
So then inside your fund
yeah,
on Avesta,
yeah,
you have the choice. Are you going to harvest that delta entirely and keep it for yourself, or are you going to give your investors a little bit more than they would go if they went direct? Is that
yeah.
basically how it was?
Yeah, so basically, each fund manager can decide how they're going to split that pie. But the right thing to do is to see if they can give about the same as what they would have gotten if they went directly to that operator. So that's sort of the norm in the industry. Of course, there can be some exceptions at times. Some fund managers say, you know what, I'm going to give slightly higher to my investors than normally if there's enough margin in the deal to do that. Of course, the fund managers have to make a living as well. But yeah, it just varies. But usually,
So,
yeah.
mm.
Yeah, no, no, yeah. Basically, normally we don't get such generous terms from operators. It's rare. Usually, there's only a 10% delta between what they're offering to their LPs and what they're offering to their fund managers. Generally speaking, it's a 10% delta.
So why would an investor invest through you with a sponsor if the terms, or through any allocator, and we can talk in general terms as well, Bobby,
Yeah,
but
yeah,
why would they do that, not go straight to the
yeah,
sponsor?
yeah,
And why, yeah,
yeah.
what motivates them? What's incentivizing?
One huge reason. The fact that the fund managers that we work with through Connected Capital or that they work with me directly, we've gone through a tremendous amount of due diligence, which the typical LP would not be able to do, or they would have spent countless hours doing the level of due diligence and underwriting and background checks that we are able to do it because of scale. So they can be confident in that where they're investing, that the operator, the fund manager, has talked to the operator and they've done their homework. They're crossed all the T's and dotted all the I's. That the numbers make sense. That the operator has been researched, their track record, the terms of the deal itself. As you know, Adam, we go through a vast due diligence and underwriting process. It's really deep, and so that's the benefit that a typical LP would not get if they tried to go directly. So they get the benefit of that research. Secondly, they've already got an established relationship with the fund manager. They've got their account, their bank account tied up to it.
Mhm.
They just log into one place and it's all there. So just the ease of doing business with that fund manager is there. Plus so that's but the ease is just the bonus. But the meat of the reason why they should go with uh, the fund managers that they've done their homework.
Um, and and okay, so I'm asking you personal questions, and that's fine, but I'm also interested in kind of generally what you're seeing in the market because you see and work with the Connector Capital, you see and deal with a lot of fund managers, what are called fund managers, let's just call them allocators, capital allocators.
Capital
We've
allocation.
talked about the jargon before, you and I. But what you've seen as well. So when you set up a fund in Avesta and then you negotiate with a sponsor and you put all this whole thing together, do you always invest in the deals as well? And do you see allocators doing that? I mean, what do you see in
Yeah.
the industry?
So we always invest in the deals that we are going to put our investors into. In fact, we are the first ones to invest in those deals. Then we use what's called backfill. So let's say we were to write a check for 500,000 for a deal that was vetted and everything, and it was available on our platform. Then we write that check, right? Then we backfill from our investors uh, over time. It could be the next day, it could be the following 3 months until uh, the allocation is completely taken up. Now, sometimes the allocations, we leave 10% for ourselves, um, but we always put up our money first. We have skin in every deal that we put up on our platform. We're the first ones to invest.
And do you always leave money in a deal or do you
Yeah,
backfill
pretty
all of it?
much. So,
Yeah.
95% of the time we leave money in the deal. 5% of the time there's such a demand and that people they want certain properties they do want. So then it gets filled up pretty
Mhm.
fast. But the way Avister works is we still have units in that deal because of there's a it's a three-dimensional kind of an approach because there's a time factor. So just a little technical here, but
Sure.
I'll share something.
Mm.
So let's say we funded 500,000 into a deal on day one. Then on day 15, an investor came in and they invested 10,000 in that deal. Okay, so they'll get a certain allocation. Let's say 3 months from then, another investor came in with $10,000, same amount, same amount. They will get slightly fewer units than the investor that came in on day 15. And the reason for that is to reward the investor that came in early into the deal. So this is a proprietary Avister algorithm that they use to make sure that the investor that came in early for the same dollar amount has more units than the investor that came in much later. And I think that's just it's the right thing to do. It's the right algorithm.
It's interesting.
Yeah.
What exactly is that doing then? It's somehow allocating some kind of risk metric, right? De-risk. If you come in later, then presumably it's a bit less risky. But
Yeah.
is that strictly, do you know how that works? Is that strictly time based or how do they
Right
calculate?
now, it's strictly time-based.
Uh, okay, so that's interesting. I don't quite understand how that works.
Yeah,
Thank you for sharing it. Yeah.
well, the whole idea
Mm,
is the investment. I think, like you said, it has
mm,
to do with risk or you
But
know,
their capital account still looks like 10,000, right? And they
yeah,
still
yeah,
look like they have
the
10,000.
capital.
But by having fewer units, oh gosh, I don't know. I'd have to look at that bit more detail. But anyway,
When you have more time, we'll do a three-way call with them, and we'll explain how it actually flows and how it's computed, because it is a key factor in encouraging people to invest early.
yes, let's do that. Let's table that and do that. It's
Yeah,
a really interesting thing to talk
yeah,
about. So back onto this topic of co-investing, though. So I was
yeah,
asking about co-investing. Actually, you put up the money first, which is interesting. So you are taking some risk
yeah,
in that. Then you backfill, all right.
yeah,
But do so. How do now? You know a lot of allocators. This is your, on the connected capital fund side of things. This is your business. So how do other allocators do it? Do you see other allocators? I want to ask this question. Do they always co-invest? Do they always put up the money up front? I'm sure not. But do they always co-invest, which is what I'm most interested in?
most of the time they do, but not always. They can pre-raise the money. It's called a soft commit. They can raise money even before they invest. They can get soft commits from their investors. But to be honest with you, I don't know, but my sense is that most of the time they co-invest. They leave some money in the deal along with their investors.
But it can't be that all allocators upfront the money that they commit to a sponsor, right?
No, most of the time they're taking on they do what's called soft commits, and then when they have the money in the bank in the the wire in the bank, that's when they do the allocation. But they usually have a window of time in which they gotta if they gotta whatever they committed to. So for example, if they committed to 500,000 and they only raised 450. Well, they got to come out of pocket 50,000. But the beauty of the Avisure platform is if somebody else came in after that and they wanted a piece of that 50,000, they could still get it. So it's flexible that way. It does make the life of the capital allocator a bit easier, because versus the old days where they had to come up with all the money all at once, you had a deadline, you had to wire your money in by a certain date. And if you didn't do that, you were shut out of the deal. But the way it's set up right now is, yes, you if you're short, you can put up your own money, but with the degree of confidence that you'll be able to backfill it.
Okay, so let me ask you this. So let's just say that you've got back onto this $500,000 commitment. So you have 500,000 and you're 50,000. Well, and you back, so you're 50,000 short. So the allocator puts in their 50. And then a week later, someone comes along and says, "Oh, yeah, I'd like to allocate some of my money to that deal."
Yeah,
So now the sponsor says, "Okay, you can have my 50,000."
yeah,
In the case where somebody else shows up and says, "Hey, wait, I also want 50,000,"
yeah.
does the Avista platform allow the allocator to go to other people who have units in that same deal and say, "Hey, look, somebody else wants it. Do you want out?"
No.
So the only person that can essentially put money in and then distribute that to other people is the allocator themselves.
Allocated. Yeah.
Yeah.
Plus, the allocator doesn't want their LP, socializing with other allocators, right? It's their investor. They worked hard to build a trust and relationship with that investor. Uh, they they don't want their LP to go and now know about other
No,
allocators.
no. What I meant was, sorry, I know it
Yeah,
sounds a bit because the terminology is difficult to use, but an allocator has two investors that come along,
yeah,
all right, and they both want a $50,000 share in this example,
yeah,
but the thing's already totally sold out. Another investor, can another investor give up their share for?
Oh, another investor.
Yeah,
Yes, they
they
have.
can.
They can. Yeah, and
So
another,
it's like a trading platform. They could actually trade. You
they,
can actually trade.
they have a new feature called continuous offerings, in which if another investor is willing to give up their share, then
Mm.
then yes, they can exit out, and then another investor can come in.
And is that and that is structured what at par, at some
Yeah,
premium, at discount? Like how do or does it depend? Like
I believe it's at par.
pass whatever they invested first, but presumably there's some flexibility on that as well.
Yeah,
So what about other? So what you're seeing in Alex? So you've talked about the way that you make money allocating, right,
yeah,
as an
yeah,
allocator,
yeah.
and the way that you make money is with taking the delta, right? You harvest the delta between the terms you negotiate, the terms that your investors get. But are there allocators who charge fees?
They can. It's, if as long as they disclose it, they can.
And do you see that much though?
Um, Maybe 10% of the time I do see it where I know in a couple of cases there's a fund manager who passes everything to their LP, whatever terms that they're getting, they
Mm,
pass it transparently or equivalently to their LPs, but then they charge a 1 or 2% or so asset management fee across the size of the portfolio, which is completely legal as long as you disclose it.
right. Um, and just in terms of numbers, the Better Capital Fund, all right, it's got Better Capital Fund. If again, you don't have to share any of this if you don't want to, but how much have you? What is the AUM or not AUM? How much in terms of equity has been raised for that? And also Connected Capital. How much has Connected Capital raised and placed?
The Better Capital Fund, I prefer to it's
That's
double double seven digits, but um,
and Connected Capital.
Connected Capital in 2024, we raised 11 million for our
Incredible.
allocators. I'm
Right.
sorry, for allocators raised for the sponsors, 11 million.
Right.
Yeah.
Yeah, that's right. And that was your first year in first year, right? It's tremendous. So how have the deals that you've seen allocators? Let's talk about this again, kind of broad sweeps, because you
Yeah.
see this industry very well,
Yeah.
Bobby.
Yeah.
So how have the deals that allocators have been involved in over the last few years, and you've been particularly involved in the last 12 months, probably
Yeah.
2 years or so,
Yeah.
how have you seen them faring?
Yeah. Um, the honest truth is not very well across the board. Um, they have made mistakes, and they've made mistakes in judging the sponsors. So there's three players. There's sponsors, there's capital allocators, and then there's limited partners. And limited partners can invest directly or they can invest through an allocator. There's some people that are very good at raising capital. They've got they've systems down. They've learned from the Adam Gowers of the world.
Hopefully not. I mean,
No,
I
no,
don't want the
no.
bad guys to learn anything, but anyway.
But
Yeah.
they've got their like you and I talked about this morning with Mess and Madby, which is they have their slick marketing down, right? But they are slick marketers, but they're not good underwriters. They don't know how to do due diligence. So they're investing with operators that just have the numbers seem to make sense to them. They have a good pitch, they have a good website, they have a good PDF. The Excel, it's whatever. But they invest and then they get burned. I know dozens and dozens of them. The reason why we exist is that we don't want to we want to eliminate or reduce the risk of getting burned by doing our homework up front. And then later on, I'm going to maybe one day in the future, we'll do another podcast about pre-wiring the money and then post-wiring the money. We'll talk about
Oh, yeah, we did talk about
that.
that. Yes.
But pre-wiring the money, we believe if you can determine and eliminate at least, well, step one, determine what are the risk factors. And then if the risk is too high, then just decline the deal, which we do, by the way. We reviewed close to 50 deals and we invested in six. So almost 10% is our percentage of the deals that go through. And it could be multiple reasons. It could be a great operator, great asset, but the wrong market. It could be a great operator, not so great an asset, or maybe their loan wasn't quite right or whatever. Or it could be the operator just doesn't know what they're doing, which happens occasionally, but not that often. So, so Adam, to what we want to do is we want to eliminate the risk of investing by doing our home
Mitigate. I'm going to help you
mitigate it,
mitigate the risk.
mitigate the risk
Yes.
up front. Um, but that's why we exist.
That's Connected Capital Fund you're
Yeah,
talking about. Bobby, let me ask you this there. So actually, let's touch on this topic
yeah,
of pre and post communications, because I think it's very important. We don't need to drill too deep.
yeah.
But what are you talking about there? And we did talk about this morning. I'm not going to put words into your mouth, but just do repeat this insight, because we do have sponsors. I mean, I've got lots of sponsors in my network that are going to be listening to this.
Yeah,
They want to know, and you
yeah,
should be telling them clearly. What have you seen
yeah,
happen with sponsors? Especially, you were talking about the glossy PDF, the glossy, flashy ones that love you until what
the
happens. So
beautiful
tell me.
websites,
Yes.
the immediate responses to your text messages, and the willingness to jump into a Zoom meeting at any time. So those are the people that, usually because they're looking for money, they're very responsive, right? Once they receive the money, once they've got everything from their investors, not every time, but often, especially when things are not going right, they will stop communicating. They will stop responding. They will find reasons for the returns being short, from what they promised. So they tend to, but again, I'm not saying everyone. So some of them are amazing
Yeah,
at
but this is something you've seen, isn't it?
something I've
Enough
seen.
that it's
Yeah,
pre
yeah,
prevalent. Yeah.
yeah. It's not all that prevalent, but it is.
Mm,
You can spot the problems by how they communicate. And of course, by the returns, at the end of the day, what we care about is what did you promise and what did you deliver? And if that's not happening, then what are the corrective
mm,
actions that you're taking? So, but yeah, I think, Adam, you've seen it yourself, but most of the time we've already vetted them and we've seen their track record, we've
mm.
checked their reputation. By the way, that's something we do. To qualify to be through Connected Capital, they got to have a track record, right? They can't be a newbie. Unfortunately, we
Good,
won't.
good they have a track record. It's not, you don't want someone who's just doing their first deal is 400 unit ground up development in
In Los Angeles.
right.
No,
We don't worry about rent
no.
control or anything in Los
Yeah,
Angeles.
zone.
Um,
Yeah,
so actually, so let me ask you this question. So it's kind of digging a little deep into the psychology, because a lot of, this is a new industry.
yeah,
There's no right or wrong. I'm just interested in your opinion. So where you have these sponsors that are super charming, I'm putting a little bit of words into it, but super charming
yeah,
until they get the check.
yeah. Until
And
then,
then when they get the check, suddenly it's like a light switch. Suddenly they go quiet, right? They've forgotten it. What do you think that says about them?
Well,
Yeah,
yeah,
and how do you think they think
yeah,
about you? How do they view you?
yeah. So one is my theory is now they're not they got the money now they got to run the property, right? They got to talk to the property manager, the construction crew, the evictions, deal with the city, and so they're busy. Okay, so you give them the benefit of the doubt for the first 6 to 9 months because they got their
Uh-huh.
hands full, right? I mean they got to be on the job site, they got to manage the property manager or making sure that the tenants are paying. They got to now do the bookkeeping and the accounting and all that, right? So 6 months is a grace period for them to like say, hey, listen, we're busy. Sometimes they got to go in and change the property manager. They got to fire the old property manager, or maybe they got to change the systems, right? The property management software, or they got to change the accounting system, or whatever. So again, got to give them the benefit of the doubt for 6 months or so, but after that, they got to start communicating. After that, hey, listen,
And those that don't, which are the ones you're talking about, what do you think that says? What does that tell you
um,
about how they view you or who they are, actually?
no, they view, I mean, I can be very blunt. You're just another victim, another dead, deer on the road, a roadkill. You're just another roadkill. And, they're gonna do whatever they want with that money. And they're gonna, in my case, well, in one of my cases through one of my other funds, he was paying his wife a consulting fee, and he was paying his brother a consulting fee, and basically siphoning off all the proceeds from the syndication. And we didn't find out about that until it was too late. The property was already distressed, and no returns, and so on and so forth. Ended up taking legal action and so on, but at the end of the day, there won't be much of a resolution there. But so there are people that are sponsors that are psychopaths. Okay, and our job is to identify those. And until you've been through the ringer, until you've had the experience, you won't be able to identify those sociopaths or psychopaths. And but they're out there, and they look just like us, and they're taking everybody's money. They're they changed their company names, they changed their websites, but they have the same approach. And one day, maybe you and I will do another podcast on things that go wrong, but we can dive deeper into that. And but it's happening. It's been happening. It's happening today, and it's going to happen in the future because it's human beings that we are trusting our money with, and
So,
they
so
can be.
let's talk about allocators again a little
Yeah,
bit. Back to
yeah,
the allocators. And again,
yeah,
this is your world, very much so. You provide incredible educational resources and other access to tools and uh, whatever. Anyway, through connected capital to the due diligence, everything, you provide a lot to allocators.
yeah,
So let's talk about that community for a little while. One of the biggest concerns that I have, and I've talked about this a little bit, and we've talked about it, is the question of compliance. Because what we're doing is these are securities, there's securities laws that we're dealing with. So, yeah,
yeah,
you've got bad sponsors, but to what extent do you see a level of understanding of the complexities of securities regulations amongst allocators? And what
yeah,
kind of challenges do you see in terms of compliance from allocators?
yeah. So look, the biggest uh, three or four sort of the low-hanging items that come up the most frequently
Mm,
are, the know your client, know your investor, and that they have, of course, they have to be, most of us are running 506Cs, so they have to be accredited. Fortunately, platforms like Avister, and Avister is not the only one, but most platforms have now got some sophistication built into them to check that the investor is not on the what's that list?
OFAC.
Yeah, yeah,
OFAC.
yeah, yeah,
Yeah.
yeah. So that they're not on that list. So there's third party services. That's all they focus on,
Hmm.
is verifying that they're not on that list and that they are accredited. So we don't get to see our investors' financials. What we all we get to see is that they applied through this third-party system to be verified as accredited, and then when they are approved, all we get is a yes or no, a letter saying that, John, who applied to be a limited partner on your platform, he's accredited, right? So they provide us with a letter, and we have to upload that letter
Right.
into
So, but
the
that's just one aspect
the one small aspect.
of compliance. The kind of thing that I'm talking about is where you have somebody who doesn't really understand this business or doesn't understand it at all,
Yeah.
and sets up an account at Avista. They get themselves a fund, and it's made super easy to do that. Now you're in business, and you click this button and that button. You've got a bunch of sponsors in there that you think they've got a nice website, and you go out. Again, I'm not saying you, but in general, is this something that you've seen?
Yeah.
And they start talking in terms that are non-compliant with securities regulations. In other words, this is the return you are going to get, not projected
Yeah.
returns,
Yeah.
or build wealth guaranteed,
Yeah.
guaranteed returns, right? Returns day one, guaranteed, or whatever. To what extent do you see violations of that kind of compliance as being an issue in the capital allocator
I
business?
I think a lot of newbies are making mistakes uh, if they surround themselves with the right people, the right peers, then the peers can sometimes correct them, right? And they can say, listen, I saw what you posted on Facebook. It's out of line. It's not right. So through connected communities like Connected Capital, we can provide some sort of a support and guidance for those folks. And I think, but the vast majority are obviously not part of Connected Capital. So there's people out there, and them, I know them, that are making false claims. Hopefully, somebody's flagging it and pointing it out before they get in trouble with the SEC. But there's a lot of false or even the word preferred return is misunderstood. Some people think preferred return means guaranteed return. No, you and I know it's not a guaranteed return. But sometimes the not so sophisticated LPs will look at a preferred return and say, wow, 8% preferred return and, 18% IRR. I'm going to get, no, no, that's not how it works. So a lot of people are advertising as though that 18 or 21% IRR is guaranteed. There's no guarantee of that. They can come in short, maybe they can overshoot it, but there's no guarantee. So part of what we want to do, you and I and our whole community, our job is to protect the LPs and educate them, right? So the best way is to educate them. Other examples, such as
I'll tell you what, Bobby, before you go to other
yeah,
examples,
yeah,
we are coming up to the top of the hour. And I actually got a hard stop at the top of the hour. Right, really, other people are going to join this call. So I would like to continue. We've got some other
yeah,
topics. And
Yeah.
as we get deeper,
Yeah.
or as I get deeper into this podcast series, let's
Yeah.
let's definitely revisit. All right, we definitely be good. We should
Yeah.
definitely. There's all kinds of things to
Yeah.
talk about. But I do have five rapid fire
Yeah.
questions to
Yeah.
ask. If you
Yeah.
can, I've got less than 9 minutes, so maybe
No
a
problem.
minute each, and
No
I'll try
problem.
and ask them very quickly.
Yeah.
So I'm
No
not so
problem.
good at just to wrap up. All right, and then we'll
Absolutely.
revisit.
You got it.
First one: what's been the hardest lesson you've learned in real estate?
The hardest lesson I've learned is trust no one. Unfortunately, I have a personality of trusting people, and going forward, it's going to be I've learned it's been an expensive lesson, but trust no one.
Second question. So, what have you actually? This is that's quite an interesting. What has been the most effective way you've found of building your investor network?
Yeah,
I'm talking about accredited
yeah,
investors. What's been
yeah.
the most effective way you found?
Authentic, genuine relationships built over time, not over a weekend, but over a long period of time.
Mm.
I was very fortunate. I lived in San Francisco and I built one of the largest real estate meetups, which is now running for 13 years. So basically, just building authentic relationships, not only about doing deals, but about caring about them, them caring about me. And I think that's where it comes from.
So, would you say that having meetups is a good way of creating those, or is there any other method
Uh,
you found for gathering accredited investors or investors that you can start to develop relationships with?
I believe that all you need as a fund manager is 100 trustworthy investors. That's all you need is you need 100. If you can exceed that, great, but you don't need more than 100. Um, Meetup is one. The other is your own, whatever network you're comfortable with. Some people are not comfortable with meetups. They're not. I think we talked to somebody today who's an introvert. Okay, well, no problem. But build that network. You need 100 people. There's got to be 100 people who like you, trust you, and they know you. So it could be from your church, it could be from your synagogue, it could be from your golf, or it could be from your college fraternity. Doesn't matter. From the military, doesn't matter. But you got to have 100 people that are accredited that will trust you with their money.
Okay, three more questions, so let's go fast. What do you think is the most, sorry, what do you think makes for a successful capital allocator in today's environment?
Yeah. Trust, knowledge, and likability. So you got to have all those three attributes, which means you're capable, you're trustworthy, and you're likable.
If you could go back in time, Bobby, and give yourself some advice before you got into the allocator business, what would that advice be?
Um, Surround yourself with people of high IQ. What I mean by high IQ is high financial and real estate IQ, uh, uh, high integrity, and highly motivated.
Last question. Thank you so much for going through the gauntlet of my questions on this podcast. Last one, promise you. What do you think is the biggest misconception about the capital allocator industry that there is today? What's the biggest misconception?
I think it has to do with trust, and uh, the misconception is capital allocators maybe make a lot of money. A lot of them are they're trading their W-2 for a little something a little bit more flexible, but they want to make a little bit of money. A lot of them don't understand how complex and sophisticated and we just talked about compliance and accounting and all that, but it is not an easy business. So you do need if you're going to make real money, You gotta be dialed in. You gotta be in the support groups, and have the right and most importantly, have the ability to raise capital. But raising capital is not easy, as you teach people about that every day. I'm sure a vast majority of your students are successful, but not everybody. But capital raising is not easy. It's not for everybody.
Bobby Sharma, better capital fund, connected capital fund,
Yeah.
and fabulous fellow. Thank you so much for joining me on the podcast today.
It's been a total pleasure getting to know you over these past few months, and I know we're gonna do great things to serve our friends along the way. Thank you.
All right, that was Bobby Sharma. Bobby, thank you so much for joining me today. It's fabulous to see you today. Thank you so much for sharing all your insights. It's been really also fabulous to get to know you over the last few months, and I look forward to an exciting and ever evolving year with you in 2025. And thank you too, dear viewers, for joining me today. I'm sure you found the conversation with Bobby extremely interesting. And if you have not done so yet, please go to garacrowd.com and sign up for my newsletter. It's totally free, comes out every week, and I share in that all kinds of insights into what I'm seeing in the world of real estate today based on my extremely long track record and career in commercial real estate going back, I don't even want to say over 40 years. I do like to say over 30 years. It doesn't make me seem so old, but it's actually over 40 years. Anyway, there it is, garacrowd.com. You can always unsubscribe. Just hit the subscribe button there on the homepage. Okay, thank you again for joining me. But for this week, this is Adam Gower signing off.